Excel accounting practice problem. Advanced customer payment or unearned revenue method number 2. Get ready because we're going to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it. If you have access to it, there's 2 tabs on down below, an example tab and a practice tab. The practice tab starting out where we left off last time, the example tab in essence being an answer key. Let's take a look at it now. In prior presentations, we put together a deposit or a prepayment, which should be a form of unearned revenue, in a way that logistically you might see with accounting software to make the connection of the deposit tie out to the invoice that's going to be later created more easily. Now we're going to do method number 2 of a similar process, imagining a similar scenario where we get paid in advance. In our scenario, we're imagining we have guitars that we are selling. Someone comes in, orders a particular type of guitar, we don't have it or we need time to get it, and we ask for a down payment in order for us to hold on to that guitar or to order that particular guitar so that will commit the person, the customer, to the transaction. Now, this method will look more traditional, look like the proper method in essence to someone that's learned the accounting with regards to debits and credits, in that we're going to record the transaction as a credit to the unearned revenue account when the deposit is received, as opposed to a negative accounts receivable. But we also want to list out kind of the problems with this when you think about doing it in like a software, like a QuickBooks. So there's going to be pros and cons from a logistical type of standpoint. And the con is that when you put it into the unearned revenue, even though that's the correct way to do it for reporting purposes, it becomes a little bit more difficult to tie out and track to the actual invoice that's going to be created later, because the accounts that are complementing the customers is the accounts receivable and subledger related to the accounts receivable. So from a journal entry standpoint, this works quite well. When you add and think about the level of complexity that would be in place with a software, then you got to take into consideration that added level of complexity. It's possible to do, and we'll talk about it a little bit more as we enter it. But there's pros and cons to both methods. So let's go back to the practice tab and put this in place. Let's do some cleanup work. First thing we want to do is make sure we got our cells hidden. So I'm going to put my cursor on the skinny column all the way to column A, right click and hide those cells. I'm going to copy the ending balances from the prior presentation and make those our beginning balances so we can focus in on the trial balance with the work we're currently doing. So I'm going to paste it 1, 2, 3. I'm going to delete the items in the middle, removing them so we can focus in on what we're doing. The detail will be in the GL. And then we're going to make some more space because we don't have enough room down below for these transactions. So I'm going to copy from F to I, Control C, put that right in the skinny column, skinny J, and insert there. So right click, right click, right click. It's having trouble right clicking. And then insert the copied cells. And then I want a skinny between the I and the J. I'm going to copy this skinny and I'm going to insert it between the I and J. Right click, right click, right click, and insert. The right click's a little sticky these days. And then I'm going to hide the ones to the left, putting my cursor on the skinny, going to the left to F, right click and hide. I'm going to right click and hide that stuff. And then I'm going to format this. I'm going to put my cursor on the first 4 cells, home tab. We're going to hit the paintbrush and just format paint this on down. So we got a nice clean blue slate to work with. Blue canvas, if you will. Okay, so then let's say this is going to happen on 2/27. So we're imagining someone comes in, they want a guitar. We'll say, hey, we'll hold on to it. Or maybe they called in, they want a guitar. We'll hold on to it for you, but you have to give us a down payment of $100 in order for us to do so. Otherwise, we're selling that to the first person that comes in. We're going to put it in the front display shop, window to make sure to sell that one. So you got to lock it down. So they're going to give us money. So we're going to say this is going to go into undeposited funds. And then the other side's not going to sales because we haven't made the sale yet, because we haven't given the guitar. We've got a down payment, a deposit. We have unearned revenue. So this time, instead of making a negative receivable, we're going to post it as the unearned revenue account down here directly. I'm going to make another account under the sales tax payable. So we'll select these columns, or cells, not columns. Right click and insert. The right click worked that time. That's nice. Shifting the cells down. We're going to call this unearned revenue. 0, 0, and the starting numbers, the ending numbers have populated for us, so that looks good. And that's going to be where the credit goes, representing the fact that we got money, but we either owe it back or owe the guitar, and therefore have not yet earned it. Alignment and indent, we're going to just say the $100 is what we got on the debit and the credit. Let's post it out then. We're going to post this to the undeposited funds. These two accounts look similar with the U's and whatnot, but undeposited funds, I'll try to keep them straight, is here, increasing it by the 100, both sides, because this is a balance sheet account. And then the unearned revenue down below is going to be posted in S17 equals that $100 credit, increasing both sides on the balance sheet accounts here as well for the year to date and the month of February. So then we have that in place. Now notice what we don't have here. We don't have any subledger. We don't have any, I'm not recording it anywhere else as I would have to if I assigned the accounts receivable. I'm not tracking the customer. I'm not even saying which customer gave us the money. And notice you could have some accounting software that can kind of do a workaround and try to make that work. But notice that's of course the problem, because what I would like to do is track it in the subledger, know who it is that I'm tracking, and then when I create the receivable or invoice, be able to tie out the prepayment to the invoice, which is a little bit more difficult to do when you're posting directly to a liability account while dealing with a customer. Liability accounts normally deal with vendors, like the accounts payable here up top. So that's why it's a strange kind of situation. And then we're gonna assume that we get paid now. So we're gonna get paid, and from a journal entry standpoint, it's fairly straightforward. Still, we're gonna say, okay, let's do our normal transaction when we have the invoice. Sorry, we're not gonna get paid here. We're gonna issue the invoice. So we're gonna imagine we now have the guitar. We're going to say we got the guitar, we're going to issue you the actual guitar, and we're going to invoice you at this point in time. So the normal transaction for the invoice would be an increase to the accounts receivable now, and then we have to get rid of the undeposited funds. So the undeposited funds needs to go down. So that's going to be a debit to undeposited funds. Now again, you can see how this kind of complicates the normal transaction we're doing here. It's doable with journal entries if you know what you're doing, but if you don't know exactly that $100 is tied to this particular invoice, if you have multiple kind of items in this unearned revenue, it could be a little bit more confusing to pull this out. And also, if you're making an invoice with straight data input, having someone that doesn't know journal entries, then you would like the credit to kind of pop in or pop up automatically to tie out to the invoice, which is a little bit more difficult to do when you have different accounts that you're dealing with, rather than everything being supported by the accounts receivable account. So then we got the sales tax payable. Sales tax payable is going to be down below, and then the sales, which is the revenue account. So we had to add one more account here to do this. We're going to indent these two. Then we're also going to have the guitar, which is going to be that we sold. Cost of goods sold is going to be impacted, and then the inventory. So this is our normal invoice transaction. I'm going to indent the inventory, except that we have this added detail, this added wrinkle of unearned revenue. So now we're going to imagine the guitar that we're actually going to be selling. The guitar that we're going to be selling is going to be on the subledger. So let's go all the way to the right to the subledger. It's going to be one of those EPSPs. So I think it's going to be down here. This one, the EPSP, which you can see there. And this happened on 2/27. So we sold one of those and they cost $480. So 1 times 480 is 480. Pulling that over to the ending balance, 1 times 480 is 480. We had 4 of those guitars in stock minus the one that we sold times 480. So we're going to multiply that out. 3 times 480. The ending balance is the 1440 after we record this, after we sell this $480 worth of guitar. The 480 is what we're out of balance by compared to the trial balance until we record the transaction. So we're going to go all the way back to the transaction so that we can then record the transaction, starting with the cost of goods sold and decrease in the inventory, because that's the amount that's going to be pulled from the subledger. So I'm going to say in M10 equals, I'm going to go all the way to the right again, pull this amount over from the subledge, which is going to be that 480, and the EPS, that's in DA 32, enter. So there we have it. There's the debit, there's the credit. The sales price is going to be driven by the item, typically in software. So we're going to say we sell these for $600. $600. Then the sales tax is going to be the 600 times 0.05 that we're going to have to pay the sales tax. And then instead of the debit going to the accounts receivable, we're going to lower the unearned revenue by the $100. So the amount that is owed at this point in time is what would have been owed, sales tax and sales price, the $630 minus the $100 negative sum or plug formula to get that in place, which is going to be the $530. So that's what we would like to populate on the invoice. Again, this last little wrinkle here makes it a little bit difficult for us to do so, because if it was an accounting software, it's a little bit more difficult to link this unearned revenue in a liability account to the subledger of accounts receivable, tying it to the invoice. What we would like to see in the invoice is to apply it out, is to see this actually applied out on the actual invoice. And there's a kind of a way you could do this in like a QuickBooks software where you can make like an item as you set up the unearned revenue and so on. And that works. It works pretty good, but there's still kind of some pros and cons. It works in that logistically it records the unearned revenue here as you record it instead of having a negative receivable. But it's not quite as nice in the way that it applies the credit out to the invoice, to the actual invoice, as having a negative receivable does. So there's still some, it depends on what you want to do with your accounting system. So you got to keep that in mind to think about how you want to track your unearned revenue depending on the software that you're going to be using and what types of unearned revenue you have, what you want your process to be. Okay, so let's post this thing out now. So we're going to post this out. Let's go for the accounts receivable is up top. So that's in S6 equals the 530, brings it up to $20,952 for both the February and year-to-date numbers. The unearned revenue is now going to go back down. So we're going to go back to the unearned revenue. We now have earned it. So I'm going to say F2 plus F2, scrolling up, and say that should then go down. We've got the sales tax, which is the $30 that we're going to have to pay to the state and local for the United States. That's how it is here. Usage tax would be basically the same thing. So that increases it to the 2898, also a balance sheet account. So the same for the year to date and the month. The sales then down below is going to be in cell S20 equals, scrolling up, picking up this sales number of the 600, bringing it up for the February number to the 1174 and the year-to-date number to the 57,951, and then finally cost of goods sold, not quite finally. Cost of goods sold is in S22 equals, scrolling up to the cost of the goods that are sold, bringing the February number up to 8312, year-to-date 45554. Finally then inventory up top in S7 equals the 480, bringing the balance down to the 4746 in both the year-to-date and the February number. So we're now going to be posting this to the GL. So we'll start off with this one up top. So let's go ahead and make it green. To do so, we're looking at undeposited funds. So undeposited funds, second account. So we're going to be here in AA12. This happened on 2/27. And then we're in AB12 equals left to the wall, picking up the undeposited funds, taking it up to the $100, matching what's on the trial balance, both the year-to-date and February numbers, given it's a balance sheet account. unearned revenue. That's going to be the new account that we're going to have to add because we added it down here. So we're going to go all the way to the right to add a new liability after the orange accounts here. So we want it right in here. So I'm going to put my cursor on the skinny, go to the BA, and I'm going to copy that, and we're going to paste it in this skinny column right here. Right click and not paste it, actually insert the copied cells. There we have it. I'm going to delete the beginning balances, make a 0. I don't need the second one down here, so I'm going to just format paint it and delete it by going to the paintbrush and just format painting it the normal standard, just blah cells, and then deleting them. And then we're going to go up top, and I'm going to put my cursor in BC2. Way back in BC2, we're going to say equals. I'm going to pull over the name of undeposited or unearned revenue. I get those two confused because they both start with U's. So then we're going to say this happened on 2/27, and this will be equal, and BD5 equal to left to the wall that $100 in unearned revenue. There we have it. We also have to add that to our GL checklist over here. So the GL right there, it's going to be that 100. I need to double click on it, go to the end of it, and say plus. We want to add that to our GL check number, which should bring it back in balance to there. That's that 100, and enter. So we're back to the green 0 there. We're not tying out on our net income to the year to date on the income statement thus far until we record the rest of the transactions. So then let's go ahead and ungreenify this. I'm going to go to the drop down. You could use that blue if you don't have that blue right there. It's in the more colors. It's in the standard tab. It's that blue, the Excel is Fun Guy blue. And then we're going to do this one next. Let's greenify that one so we can focus our eyeballs on it. So there's the accounts receivable, third account. On the accounts receivable, third account. This happens on 2/27, and then in the AF10 equals left to the wall, picking up the 520, bringing the balance up to the 20,956. That 20,956 matching what's on the trial balance, both the year to date and the month of February. Unearned revenue. We also are going to take a look at the subledger, by the way, of course, for the accounts receivable. But first, unearned revenue. That's the new account we have down here that we're now going to be bringing back down to 0. So we'll bring it all the way back on over to the unearned revenue in BC6, way back, 2/27. We're on BD6 equals left to the wall. Scrolling to the unearned revenue in M6, and that should bring it back down to 0. That should match now what's on the trial balance in both the year to date and the month of February. Then we have the sales tax. That's now the second to last orange account. It's no longer got that last position because unearned revenue has taken it. So now we're over here on the sales tax. We're on AY21. This is going to be on 2/27. And then on AZ21 equals left to the wall, picking up the sales tax, looking for the sales tax, looking for you sales tax, $30, bringing the balance up to the 2898. That 2898 should match what's on the trial balance in both the year to date and February numbers. Finally, we're on the sales. That's going to be the income statement side of things. That's the first income statement account. So it will be the same on the GL as well. Scrolling over to the sales, picking up the sales in BK9, 2/27. We're in BL9 equals left to the wall. Scrolling down or up to the $600. And so it increases sales to the 57,951. That's the year-to-date number. The month of February will be 1174 on the trial balance if everything goes the way it should go. That's the way things should happen. 1174, 57,951. So things have gone the way they're supposed to. Let's ungreenify this one and do the last bit here. The last bit, as they say. That last bit. And so we're going to say it's on the cost of goods sold, third blue account. We got to get that last bit done. I don't know what kind of accent that is. I'm trying to get some, I don't know. Here we go. We're going to go down to the cost of goods sold. We're on 227. We're looking BP9 equals left to the wall, the 480. So that brings the balance for the year to date up to 45,554. The month of February should be at the 8312. Let's see if that is indeed the case on the trial balance. So we've got the 8312, the 45,554. I think it is the case. I think those were the same numbers, I'm pretty sure. Let's do that last bit on inventory. Inventory, fourth account. So we're going to be over here on the fourth account. Here we are on AE30. We've got 227. We're on AF30 equals left to the wall. Scrolling up, and we're going to pick up that 480 and enter. So that brings the balance to the 4746. That 4746 should match the trial balance on both the year-to-date and the February numbers due to it being a balance sheet number. We should be back in balance up top as we are. Now we want to check out our subledgers. We can double check our inventory should be at the 4746, and we need the subledger for the accounts receivable. So let's go all the way back on over to the subledge. So this is the inventory, which is indeed at the 4746. And then we need to be taking a look at the subledge for the accounts receivable. So let's go on back to the AR. Let's go to the AR. And this is kind of the important part here. This is important. Pay attention. We're almost done. It's been a long time, but this is like the important piece. We saved it till the end. So 227, the subledge in CN5 for music stuff store. All the way to the left, we're going to be picking this up, and we're looking at that 530. So notice that 530 now in the subledger represents what is still owed after the deposit of the $100, which is good because that's what we still need to collect. But again, note that the added $100 we received from music store stuff isn't in the subledge. So we don't really have the detail in the subledge here telling us this is the deposit that they made, the prepayment that they made, and the invoice in this one number kind of looks like we made a sale for 530 instead of what actually happened, which is that we made the sale for 630 with the sales tax and so on, and that we already got $100 which was prepaid. We can't see that as easily in the subledge because that detail is in the other account called undeposited funds, which doesn't have a subledge or typically or traditionally isn't tied to, because it's a liability account, to the subledger of the accounts receivable. So that's kind of the con, again, from a logistical standpoint, if you're using an accounting software to try to tie out the invoice to the prepayment, whereas if you make a negative receivable, it can be a little bit easier sometimes to do that. So that's why you might see that in practice. Some softwares have kind of a workaround to make the undeposited funds to do it, but you could see it adds a level of complexity. So you could deal with that added level of complexity by doing whatever you need to do to make the undeposited funds correct, and then deal with the kind of disparity between the two accounts that are impacted as you deal with customers, instead of having one account impacted for the subledger as you deal with customers. And or you can have the negative receivable, which isn't quite right for reporting purposes, but then adjust it periodically with an adjusting entry, not the traditional one that you would expect in an accounting course to adjust for unearned revenue, but rather an adjusting entry that would correct the understatement. In this case, accounts receivable would be understated, so you'd increase the accounts receivable, and if you in the adjusting entry would have to increase the liability. Okay, so this is where we stand at this point in time. This is where we stand. I'm actually sitting right now, but you know what I mean. This is where we sit at this time. It sounds better to stand, though. Sometimes I stand when I'm working, but this is where we stand as I sit.